All right. Good morning and afternoon, everyone. Welcome to our webinar today. Thank you, Argano, for hosting us and allowing us to talk about our 2025 mid-year tax update. So we're looking at the tax changes that have happened this year. Lots going on in the political landscape, so we have a lot to cover today. I expect it to take around a half an hour. So feel free to ask any questions in the chat, or I will provide my email at the end of this as well, so you can email me directly. All right. So we're going to look at the tax landscape in the United States and beyond. And just a disclaimer before we dive in, I want to emphasize that while we hope you'll find today's discussion helpful and informative, this is for educational purposes only and should not be considered legal or tax advice. I'm not a tax professional, so for specific questions, please consult with your tax professionals. But we're just here to guide you here. So today, I'm happy to present. My name is Mark Apicella. I'm a Strategic Alliance Manager here at Avalara. I specifically maintain and foster the Argano partnership with Avalara. So I'm here to support Argano's representatives internally and their customers, ensuring that everyone within the Argano ecosystem is able to fully support and benefit from Avalara's solution stack, and I can help direct things along the way. I've been working in the tax technology space for several years and the Microsoft ecosystem for even longer. So I'm very much happy to be supporting my partners and customers. So for today, we're going to cover 6 key areas that are creating significant challenges in the tax landscape. First, we're going to look at the overall state of finances and what that means for future tax policy. Then we're going to dive into economic nexus, marketplace facilitator updates, areas that continue to evolve rapidly. And we're going to examine the growing momentum around retail delivery fees, which are becoming a hot topic in many states. We'll also discuss the recent tariff changes and their impact on businesses. And finally, we'll explore the worldwide spread of e-invoicing mandates, e-invoicing mania, and what that means for your operations. Then we're going to wrap up with Q&A, so feel free to jot questions down as we go or submit them in the chat. Okay, so first we're going to look at the state of the states. So first we're going to look at this big picture of the United States. We're going to understand state fiscal health. And this is crucial because it directly impacts tax policy decisions. When states face budget pressures, they often look for new revenue sources or expand existing tax bases. Looking at our map, we see a mixed picture across the board, across the country. Most of the states across the map are dark blue, showing stable short-term fiscal outlooks. These states generally have diverse economies and strong revenue streams, while the light blue states have conditional outlooks. They're generally stable, but they do face some challenges. And then, of course, the orange states, they are challenging short-term fiscal outlooks, and these are going to be important to understand because that's where we're going to see potentially increasing sales tax compliance, things like that. So speaking of expanding the tax basis, one of the biggest trends we're seeing is states broadening their sales tax to include software and services. This represents a fundamental shift in how states approach taxation. Maryland is leading the charge here. I'm actually a native Marylander, and I'm going to go back there next week to visit family. So, I'm going to be telling them about this peculiar tax change. Starting on July 1st, Maryland will tax data and information technology services, as well as system software and application software publishing at a rate of 3% of the taxable price. This is significant because it's one of the first states to specifically target these digital services. Washington State is also making moves in this space. Beginning in October, Washington will tax several high-tech services, including custom website development, data entry processing, lead generation optimization, and search engine marketing. The trend is not stopping there. We're also seeing Minnesota, Nebraska, and New Jersey considering similar legislation. The message here is clear. States are recognizing that the digital economy represents a significant untapped revenue source. All right, so just to continue on this, the expansion continues with other states taking different approaches. Louisiana took a comprehensive approach starting in January of this year. They began taxing digital goods, information services, software, and software as a service, regardless of how it's delivered or accessed. However, they did include exemptions for commercial use and specific purchaser types like licensed healthcare facilities. Vermont took a more targeted approach. Effective in July of 2024, they updated their definition of taxable tangible personal property to include pre-written computer software, regardless of where it is accessed. This clarifies that cloud-based software isn't exempt just because it's not physically delivered. We're also seeing states clarify existing laws. Georgia has been working closely to clarify terms related to digital products, goods, and codes, while Texas is actually moving in the opposite direction. They're seeking to exclude certain marketplace facilitator services from their definition of taxable data processing services. All right, so now let's look at some other significant changes happening at the state level, where we're looking at food taxation. This remains a hot political issue, and we're seeing several states making adjustments. For instance, Alabama is reducing its state food income tax, or state food tax, from 3% to 2% starting in September of this year. Arkansas is taking a bigger step by eliminating the state sales tax on groceries entirely, effective in the new year of 2026, although local sales tax will still apply. Idaho's increased their grocery tax credit to $155 per person, retroactive to January 1st of this year. Mississippi is lowering their grocery sales tax rate from 7% to 5%, effective in July of this year. And then on the enforcement side, Illinois is implementing a general tax amnesty program running from October 1st to November 15th, 2025 for tax periods ending after June 30th, 2018 and before July 1st, 2024. Illinois is also running a franchise tax amnesty program for the same period. Additionally, Illinois is planning to eliminate state sales tax on food while allowing new local taxes on food starting on July 1st, 2026. So a lot changing in this space here too. Going further in Illinois, they do seem to like to make sales tax complicated. They're making some significant changes to address challenges from businesses about the burden of out-of-state retailers. They're attempting, well, in this case, they're attempting to simplify sales tax for remote sellers, though the reality is somewhat complex. Here's how it works. Out-of-state sellers shipping goods from outside Illinois must now use destination sourcing rules, meaning they use the tax rate of the point of delivery. This began January 1st of this year. Previously, these sellers could use a single statewide use tax rate of 6.25%. However, out-of-state sellers shipping goods from within Illinois could continue using origin sourcing, the rate at which the origin of the sale, which could be the inventory location or the office where the order was taken. In-state retailers continue to follow origin sourcing rules as well, using the rate at the ship from address or order taking location. This is designed to make compliance less complex for in-state retailers. It's worth noting that remote sellers, businesses with no physical tie to Illinois, continue to follow destination sourcing rules. Okay, and that kind of wraps up where we're at with those states. Now we're going to look at economic nexus updates. So this is going to be the requirement to collect and remit sales tax based on certain thresholds, whether that is a transactional-based threshold or a revenue-based threshold. So these states here, Alaska, Utah, Illinois, and Louisiana, they're going to be dropping their transactional thresholds throughout 2025 and 2026. So that's going to really make things a little bit more simpler. Louisiana will add accommodations intermediaries to the scope of marketplace facilitators in June, expanding the types of businesses that must collect and remit sales tax. So that's kind of the main changes here. Looking at the overall map of nexus thresholds by state, just to give an overview of that, most states have settled on a $100,000 threshold, and that's going to be shown in light blue. Some states like California and Texas have higher thresholds. States in orange maintain either a revenue or transaction thresholds. Some states require both a revenue and transaction threshold, like Connecticut and New York. But once again, what's significant in the recent activity is we've seen states dropping their transaction thresholds, simplifying the compliance for businesses, since tracking revenue is generally much easier than tracking individual transaction counts. And then just a reminder, the states in white, Montana, New Hampshire, Oregon, Delaware, do not have statewide sales tax, so they don't have to They don't have economic nexus laws. Now we're going to be looking at the momentum with retail delivery fees. So retail delivery fees are gaining significant momentum across the country. We're seeing an interesting coalition building around this issue, including Amazon, DoorDash, Google, Grubhub, Instacart, and nearly 30 other major businesses are actively opposing online delivery taxes. This level of organized opposition shows how significant this issue has really become. The activity does vary by state. So in Minnesota, there are 3 bills seeking to eliminate their retail delivery fee, while two other bills would keep the retail delivery fee but remove it from clothing purchases. Colorado attempted to eliminate their retail delivery fee, but it did fail, so they still have that. However, Colorado's retail delivery fee is dropping by 1 penny from 29 cents to 28 cents starting in July of this year. And then just some factoids. Washington's Legislature Joint Transportation Committee published a report on the effect of a 30-cent retail delivery fee, but no bills have been introduced in 2025. Oregon's Road User Fee Task Force studied retail delivery fees in a report to their legislative assembly. But we are also seeing new proposals in Connecticut, Hawaii, Maryland, New York, and Vermont. Indiana also proposed legislation, but that one was struck down. Okay, so now we're going to be looking at the latest in trade and tariffs. So if you're not aware, Avalara, we do host a Tariff Tuesdays series. So if you are interested in following that series, we do present the latest on that, but I'm happy to put that into here right now. So we're going to discuss what happened and what was announced on Liberation Day, which was the sweeping tariff changes that were announced on April 2nd. The impact on businesses has been significant and continues to evolve. The announcement included reciprocal tariffs based on what other countries charge the US, including currency manipulation and trade barriers. China faced the highest rates charged them at 67% and 34% US discounted reciprocal tariffs. The European Union faced 39% tariffs charged and 20% reciprocal, respectively. But the implementation has been complex. Multiple tariff schedules went into effect on different dates, starting with Canada and Mexico tariffs on March 4th and 12th, respectively, followed by steel and aluminum tariffs on March 31st. A key point is that these tariffs were originally put on pause until July 9th, except for China and the baseline 10% tariff. But this pause has been extended to August 1st, 2025, to give businesses additional time to prepare for these changes. The legal landscape around these tariffs has also been particularly volatile. Liberation Day has not just sweeping tariffs, but also retaliatory actions from major trade partners and significant legal challenges. The timeline is important here. So on May 14th, the US and China agreed to a 90-day suspension of high retaliatory tariffs. However, by May 30th, President Trump accused China of violating the tariff truce by delaying rare earth mineral exports, leading to escalated tensions and a drop in US stock markets. The court battles have been equally dramatic. On May 28th, the US Court of International Trade ruled that many of President Trump's tariffs exceeded his authority under the International Emergency Economic Powers Act of 1977, ordering a rollback within 10 days. But then the very next day, Federal Appeals Court temporarily reinstated Trump's decision, allowing the tariffs to remain in effect. So that is where we stand today. So where are we now? The situation remains fluid, but here's what we know. For Canada and Mexico, under USMCA, compliant goods continue to see 0% tariffs, while non-compliant goods face 25% tariffs. Canada's non-compliant emergency and potash see 10% tariffs. China faces the most complex structure. There's a 30% tariff on the majority of Chinese imports as of May 14th. Section 301 tariffs remain fully in effect on many electronic and industrial products. Duty-free treatment for goods under $800 extended on May 2nd. I'll cover a little bit more of that later. Some exclusions were extended through August 31st for 164 products from China and solar manufacturing equipment. For other countries, steel and aluminum faced 50% tariffs as of June 4th. Automobiles face 25% tariffs, and there's a 10% baseline on all imports from April 5th. The individualized reciprocal tariffs from Liberation Day are on pause until August 1. And the UK does have a little bit of a special treatment with reduced automobile tariffs for the first 100,000 vehicles imported annually. So one of the most significant changes for e-commerce businesses is the end of de minimis exemptions for China and Hong Kong effective May 2nd. So previously, goods under $800 from these countries entered duty-free. Now, non-postal shipments under $800 are subject to all applicable fees. Postal shipments under $800 face a flat duty of 54% of value or $100 per package. This creates new requirements for carriers, including reporting shipments, proper tariff code classification, content information, maintaining international bonds, and remitting duties to U.S. Customs and Border Protection, or the CBP. The CBP may also change to formal entry requirements for any package. The volume impact is enormous. De minimis shipments to the U.S. have grown dramatically since 2016, and President Trump has indicated an intent to eliminate the de minimis entirely as of July 1st, 2027. Okay, so all these different puzzle pieces of global trade make tracking these tariffs and everything just significant compliance challenges. The puzzle pieces of global trade include de minimis exemptions, tariff code classification, declared value, and country of origin. All of these must work together correctly in order to properly stay in compliance. So when your businesses get this wrong, the consequences include under or overcharging customs duties and import taxes, added costs for customers and supply chains, and penalties and fines and delays for non-compliance. Our research here shows that 55% of respondents find the cross-border e-commerce business environment challenging. Out-of-date trade compliance and information and tariff rates are major risk factors. Okay, so now moving on to some other international business. The e-invoicing mania spreads worldwide. Just for the e-invoicing mandates, here's just some updates. So we're going to look at these mandates, which are spreading worldwide. Over 80 countries now have e-invoicing mandates, and more are coming. However, we are seeing some delays. So Estonia postponed their B2B e-invoicing requirement from 2025 to 27. France postponed their requirement from July 24 to September 26. Spain postponed to no sooner than 2027 due to technical specification concerns. Poland postponed from July 24 to February 26. And Germany implemented a requirement in January of this year for businesses to be able to receive e-invoices. The UK's HMRC launched a consultation on e-invoicing and could announce a proposal by November. This represents, this e-invoicing movement represents a fundamental shift in how business transactions are documented and reported globally. Just to kind of roll on to that, we do have, for those Microsoft, if this is, we are presenting this to Argona's Microsoft business unit. However, Argono in the other areas, we do have an e-invoicing and live reporting connector all to one cloud where we do keep these compliance regulations updated, making that easier. This brings us to our Q&A. And let's see, we got it down in 20 minutes. So I hope this overview of the mid-year tax changes has been helpful in understanding the evolving landscape. These changes affect virtually every business engaged in interstate or international commerce. So feel free to reach out to me directly. My email's on the screen with any questions that you may have. And before we conclude, I do also want to send a reminder that for more comprehensive details on all these tax changes, you can download our complete Avalara Tax Changes 2025 mid-year update at avalara.com/tax changes. All right, thank you so much for your time and attention today. Stay compliant and have a great rest of your day.